Hello and a very warm welcome to Victory IAS. Today we will be discussing current affairs issues related to banking, right? So the topic is related to banking issues, but let's first understand the importance of banking and what kind of issues we will be facing here. So as you know that banks and financial institutions are for resource mobilization, right? For resource mobilization. Now, when we want to understand the impact of bank, etc., how resource mobilization takes place, let's see first. This is bank or financial institution where people who are having surplus money in their hands, they will be depositing their money or depositing or investing, right? When we talk about banks, it is deposit. When we talk about financial market, it is related to investments, right? And these are the peoples who will be borrowing these money, right? So these people are having a deficit of money, they want to invest in their business, etc., so they are investing, they need investment, they need fund. So banks and financial institutions are acting as a source to mobilize resources, that is funding, right? This is bank, this is the function of bank. Now when we talk about the function and the kind of impact that the banks are doing in economy, that is RBI, you can understand that Reserve Bank of India, or for that matter central bank of any country, is having a control over the kind of commercial banks that are present in the economy, right? So what we can understand from this, RBI is the supervisor, RBI is the regulator of entire banking sector, right? RBI is regulator as well as supervisor of entire banking system, right? Now, RBI is having one policy in their hand which regulates flow of money. That is known as what? Monetary policy. That is known as monetary policy. So RBI, with the help of monetary policy, will be controlling flow of money in the economy. So will be controlling flow of money, controlling flow of money in the economy, right? Now the monetary policy are having two types. That means either it can be contractionary policy or expansionary policy. When we say contractionary policy, it is about limiting the supply. Liquidity is getting dried up, they are sucking up liquidity from the market, that is contractionary. And expansionary, when they are infusing more money in the economy, that is expansionary fiscal policy, sorry, monetary policy. Expansionary monetary policy is related to more money supply in the economy. Contractionary monetary policy, less money supply, you are sucking up the liquidity from the economy. These are the things, some basic idea that you need to understand the development that we are discussing, right? So as you can see here that MPC, that is Monetary Policy Committee, just now we have seen, right? Monetary Policy Committee under RBI, Monetary Policy Committee under RBI. So monetary policy, the decisions will be taken by Monetary Policy Committee. 6-member committee it is a 6-member committee, and 3 members are from RBI, right? RBI, and RBI governor is the head of Monetary Policy Committee. Second, casting vote, etc., that you will study with under static information. So they first bi-monthly monetary policy of financial year to 23-24. This is what I explained you, that what exactly monetary policy is, right? So the kind of decisions that they will be taking here in in the meeting of Monetary Policy Committee. The Reserve Bank of India, or RBI's Monetary Policy Committee, recently announced the first bi-monthly policy of financial year 23-24. RBI Governor Shaktikanta Das revealed that MPC has unanimously decided to keep the repo rate unchanged at 6.5%. Now let's understand what is repo rate, right? So repo rate is a kind of interest rate that RBI charges when RBI lends money to the banks, right? So these are the banks, right? Suppose these are the banks. So banks B1, B2, B3, right, etc. So BN, not many banks in an economy, right? They are in the need of funds. Suppose they are in the needs of fund. This is RBI. RBI is the regulator, right? Also supervisor. Also RBI is known as lender of last resort. This is one of the function of RBI, that is known as what? RBI is known as lender of last resort. Means when fund is needed to the commercial banks, RBI is the one who will be lending to the commercial bank. Now, when RBI gives fund to the banks, when RBI is giving fund to the banks, they are giving funds to these banks with a repurchase obligation, that is repo, repurchase obligation. What do we mean by repurchase obligation? That when RBI wants to, when banks needs to get fund from RBI, they will be selling bonds. They will be selling bonds. When you are selling something, you will be receiving money, right? So banks are selling bonds to RBI. In response of that, RBI is giving funds to the banks. But this selling of bond by banks is with repurchase obligation, that banks will repurchase these bonds from RBI within a time period. For example, overnight repo rate is also there, 14 days repo rate is also there, right? So that kind of timings will be there, predefined time limit will be there, and in that particular time banks will again purchase bonds from RBI. Now, when in this entire transaction, RBI is putting interest rate, and that interest rate is known as what? Repo rate, right? So repo rate is the one, the interest rate at which banks get funds from RBI with entire repurchase or repo operation, right? This is known as repo operation. This is the thing, right? It is one of the very important tool related to monetary policy. This key lending rate is the rate at which the RBI lends money to commercial banks. The decision to pause the repo rate is only for this meeting. Pause the repo rate means you are not neither increasing it nor you are decreasing the repo rate, right? But the committee will not hesitate to take further action as may be required in the future meeting. I hope you can recall when we discussed this business cycle. In this business cycle, we tried discussing this part. This is known as boom period. This is known as slowdown, right? And this is known as recession, when the GDP growth is negative, and this is known as recovery, right? This is known as recovery. So in this particular phase, what happens in boom period, we saw that growth is also high and inflation is also high. Now, RBI needs to tackle inflation. So, to tackle inflation, RBI goes for what? Contractionary policy. So, this is known as contractionary policy. This is how inflation is directly connected to Monetary Policy Committee. In fact, you will be surprised to know that RBI Monetary Policy Committee is not only about fixing repo rate and all, rather the decision will come through the inflation targeting that is there, right? Inflation targeting. So the target for inflation has been given to Monetary Policy Committee. The target for inflation is 4% plus minus 2%. 4% plus minus 2%. That is, the limit is from 2% to 6%. So RBI has to take a decision on the basis of inflation rate prevailing in the economy. What kind of inflation rate that is there in the economy? That is the objective here, right? I hope you can understand. GDP growth, that is why they are saying that inflation also needs to be taken care. GDP growth projection revised upwards. The Monetary Policy Committee marginally revised the GDP growth projection upwards to 6.5% for the current financial year of 23-24 from its easier estimate or earlier estimate of 6.4%. Shaktikanta Das said GDP growth in Q1 of financial year is expected at 7.8%. Now, what is this Q1, Q2, etc.? So we need to understand that the financial year or fiscal year in India, financial or also known as fiscal year, right? The year or the period for which government presents its budget. So the financial year starts from 1st of April and it is till 31st of March of the next year, right? This is known as financial year. For example, if we talk about financial year 25-26, then this financial year will start from 1st of April 2025 and it will end on 31st of March 2026. 31st of March 2026. This is financial or fiscal year, and this is the period, right? 1st April to 31st of March. Now, one thing we need to understand that we have divided this entire financial year into 4 quarters. So quarter 1, quarter 2, quarter 3, quarter 4. Quarter 1, when we say the year starts from 1st of April. So April, May, June, right? This is first quarter. April, May, June. This is second quarter. July, August, September. Third quarter. October, November, December. Fourth quarter, January, February. These are 4 quarters, right? That we can understand. So these are quarters, right? These quarter estimates of GDP was not available earlier in India. We started from 1996. So 1996 onwards, we have this quarter estimates of GDP also. Quarter estimates or quarterly estimates of GDP, right? So these are the quarters that we see in the newspaper or in government data, right? So this is for financial year 24, first quarter 1. This is followed by 6.2 for quarter 2, quarter 3, quarter 4. I hope now you will be able to understand. This shows that India's economy is expected to grow at steady pace. Now, banking and financial sector remains healthy. Governor Das also talked about the recent upheaval in the banking sector. He stated that the central bank is keeping a close eye on the turmoil of banking sector that has been developed in the country. Amidst the volatility, Indian banking and non-banking financial services sector remain healthy and financial markets have evolved in orderly manner. Economic activity remains resilient and real GDP growth is expected to have been 7% in financial year 23. Now, one thing we need to understand here, there are few terms that has been used here. One is related to this non-banking financial services sector. So what is non-banking? See, financial sector includes banks that we understand. So what are the functions of banks? They accept deposits, right? They accept deposits and they lend money to the borrowers, right? This is bank. They accept deposits here, right? Deposit. Now, there are non-banking financial companies also. Non-banking financial companies are or for that matter NBFCs are very heterogeneous type of institution. Heterogeneous means it is for various purpose. For example, NBFC for infrastructure sector, they are extending loan only, right? They are extending loan. Very large NBFCs are allowed to take deposits. Otherwise, they raise fund from bond market. They raise funds from bond market, or we can say financial market, right? They raise funds from financial market. They raise funds from financial market. So banks are having different kind of arrangement. They accept deposits and they lend money to the borrowers. NBFCs are having, for example, for infrastructure, for housing sector, there are separate. For gold loans, there are separate NBFCs, right? So on the basis of their activities, they can be classified into various sectors, right? So NBFCs are like this. Very large NBFCs are allowed to accept deposits. Otherwise, they raise fund from financial market and they lend money in those sectors where gestation period is very high. The loan is needed for long period, right? And less interest rate, etc. So NBFCs are there for this particular purpose, right? You might have heard about ILNFS defaults. These kind of NBFCs are already there in India, right? The stakeholder were SBI, LIC, etc. Now, so this is done. Now coming to this particular slide. So these are some current affairs information with which we can also learn the static part or we can revise the static part. For example, when we talk about moderating inflation, I hope now you understand what is inflation. Inflation is nothing but general rise in price. Inflation, when we say inflation, is general rise in price, general rise in price of commodity. It commodities may include goods as well as services. Commodities, goods as well as services, right? This is general rise in price of commodities. This is known as what? Inflation. So in inflation, we take somewhere around 300, 400, 500 commodities, right? And we observe the price change, right? With some base year, we observe the price rise with some base year compared to some base year, and how it is. This is known as inflation. Now there are various measurements of inflation, various measurements of inflation. Uh, but the headline inflation is known as what? If we say something as headline, like Monetary Policy Committee also takes into account repo rate, right? There has been a lot of talks on repo rate. So when we talk about repo rate, it is a headline policy tool, right? RBI will be using that particular tool to control inflation, right? So headline inflation, when we say, it is the variant of inflation or the measurement of inflation which is used for policy purpose, right? So inflation used for policy purpose, this is known as headline policy purpose. This is known as what? Headline inflation. Yes, headline inflation. So headline inflation is this consumer price index combined. Consumer price index combined. Otherwise, there are lot many measures of inflation if we study, right? Lot many measures of inflation. For example, this consumer price index, wholesale price index, right? Under consumer price index also we have a lot many measures like CPI urban, CPI rural, CPI rural, see this CPI combined, right? CPI for so these are few measures, right? Now WPI also for wholesale price index it is, right? So we are having various measures, but when we talk about headline inflation, this CPI combined is known as what? Headline inflation, right? So despite the headline inflation moderating, it remains well above the target of RBI. Now you understand what exactly the target of RBI. The target is from 2% to 6%. These developments have led to heightened this volatility in global financial market. Global financial market, the inflation was high in this 23, 24, even 22, 23 because of Ukraine, Russia, Ukraine war. Then this Hamas Israel conflict that was going on, right? So lot Houthi rebellions or Houthi rebels when they were attacking cargo ships in Suez Canal, etc. So that's how the prices were high. So global inflation was high in this particular period. However, the current financial year points towards the soft. Governor Das said that war against inflation will continue until there is a durable decline. The central bank has projected inflation to marginally decline to 5.2% in financial year 24 with 5.1% in quarter 1, and these are the data for different quarters. This was projected. Maintaining an agile approach for liquidity management, right? This is repo rate, etc. When we are changing it, it is part of liquid adjustment facility, LAF, that we say. It is part of LAF, liquid adjustment facility, right? So we are having agile approach, hawkish approach, dovish approach when we are changing repo rate. If we are increasing it, that means we are going for contractionary policy. If we are decreasing it, we are going for expansionary money, right? This is maintain an agile approach for liquidity management to manage the government's program in a non-disruptive manner. The current account deficit. Now, what is current account deficit? When we say current account deficit, it is related to what kind of transactions we are doing with other countries, right? External sector in the economy. So what kind of transactions we are doing with external sectors of the economy, that is known as current account deficit. There are two accounts under balance of payment. This is part of balance of payment. Part of balance of payment, we are having two accounts, current account and capital account. Current account and capital account. Capital account, there are different things, but when we talk about current account, it is there is, for example, this export import, right? Export of goods, export and import, you can say export and import are part of what? Current account. right? So when we are exporting goods as well as services, when we are importing goods as well as services, so what kind of deficit? So when we say current account deficit, when we say current account deficit, that means our exports are high, exports are more, right, and imports are less. Exports are more and imports are less. This is current account deficit. Or when sorry, exports are less. When we say current account deficit, that means exports are less and imports are high. That means we are earning less, we are spending more. That is how we are in deficit. When we say current account surplus, current account deficit and current account surplus, when we say surplus, that means we are earning more. When we will earn more when we are exporting more. So when exports are high and imports are less, when exports are high and imports are less, that means we are in surplus, right? So here we are talking about current account deficit of India is expected to remain moderate in fourth quarter of financial year 23 and also eminently manageable going forward. The Indian rupee moved in an orderly manner, but the RBI will remain watchful of the currency as well, right? Currency exchange rate, that maintaining the stance on withdrawal of accommodation. Accommodating stance, that means you are going for contractionary policy. The RBI's MPC has maintained its stance on withdrawal of accommodation. The central bank has raised the repo rate by 250 basis point in the last 11 months since May 2022. The repo rate is one of the primary tool to manage inflation in the country, right? This is what I was explaining you about repo rate. With inflation still above the central bank's target, that is 2% to 6%, maintaining the repo rate at 6.5% is necessarily or as a necessary step to control inflation. Over the course of the next 4 days, the Monetary Policy Committee of RBI will deliberate whether interest rate should be hiked further or not. Now, what kind of background is there? Why we are discussing on this? Since May last year, RBI has been raising the repo rate continuously. Repo rate is being increased 25 basis point. That means 0.25%. The rate at which the RBI lends money. That is what we have already seen. What is the repo rate? Banks to other financial institution charge higher interest rate. When our repo rate will be high, that means our banks are receiving higher money. Banks are receiving higher money money at higher interest rate from the RBI. Then banks will also be charging higher interest rate. That is the kind of mechanism we are having in our country, right? Higher interest rate and existing EMI for home, car, business loans have been going up. This is the idea of continuously increasing repo rate. So if repo rate is getting increased continuously, then this will be the situation, right? Now, the pros and cons of raising interest rate. So if interest rate is getting high, it contains inflation. The pros, the advantage here is that it contains inflation. That means higher EMI would dissuade enough people from borrowing money to higher inflation. That is referred to spike in people. This is not the thing, right? Borrowing fund future economic activity. So slowdown in expectation of future inflation, demand for money, bringing down inflation. So what exactly is that you need when we are having contractionary monetary policy? When we are having contractionary policy, that means or contractionary monetary policy. So when we are having contractionary monetary policy, that means what? Repo rate is high. Repo rate is high. When repo rate is high, what will happen? Interest rate will also be high. When interest rate is also high, then people will spend less in economy. When people will borrow, interest rate is high, no? So people will borrow, so less spending, right? Less. This is right. Too much money chasing too few goods. So what happens basically? Why RBI is going for this contractionary policy? Because in the situation when demand is too high, but supply is less, so what will happen in this situation? Demand pull inflation will happen. This situation, demand pull inflation will happen, right? Demand pull inflation. The prices will go up in this particular situation. When prices are rising, we have to control inflation. We have to control rise in price. So this is how we can control, right? What is the cons here, right? What is the cons? So what RBI will be doing here, RBI will be going for contractionary policy, and this is how the less spending will be there, less disposable income will be there in the hands of people. And when less disposable income in the hands of people, what will happen? The people will be reducing their demands, and that's how we can contain, right, this. Limit India's economic expansion and make unemployment worse. When we are increasing the repo rate, then this is one situation which we have to deal with. That is, the growth will also come down and unemployment rate will become hike per se cannot improve the supply of those goods and services. What we are doing basically here, see, when we talk about this particular situation, right, we are trying to cater this demand pull inflation, but this less demand will not be taken care by rising interest rate, right? If demand is less, if supply is less, less supply cannot be taken care by a contractionary monetary policy. Rather, you have to do a lot of reforms. For example, you have to reduce cost of inflation, you have to reduce logistical cost, etc., so that you can have better supply in the economy. Otherwise, just by reducing or just by increasing the repo rate, you will not be able to cater supply side constraint. Demand side constraints you can take care, but supply side constraint cannot be. That is known as what? Cost push inflation or supply side inflation. Supply side inflation cannot be taken care by a contractionary monetary, right? So that we need to understand. A contractionary or tighter monetary policy or higher interest rate increases inequality in an economy also, because the people who are having higher purchasing power, they are less affected by contractionary monetary policy. Thus, bringing interest rate down reduced inequalities. From 2008 global financial crisis until the war between Russia and Ukraine, most central banks practiced an expansionary or loose monetary policy. That means low interest rate. That means flooding the economy with the additional money surrounding spurring economic activities. That means economic activity will increase. But there was growing criticism that low interest rate were leading to higher wealth inequality. When interest rates are low, what is happening here? Savers barely get any reward because interest rates are low. So you will not be receiving higher interest rate on your money. So save you lose. That is, most of the wealth creation happens in stock market, and stock market are mostly owned by rich people. That is, who are believing in the policy invest. And what should be done given the harmful effect of both contraction and expansionary monetary policies of inequality? So, as we have seen, if we are going for contractionary monetary policy, then also the rich people are getting less impacted by it. So you are increasing inequality. When you are going for expansionary monetary policy, loose money policy, at that time also what is happening, savers will not get a lot of reward, right, lot of returns. So people who are investing in stock market will get more reward, and that's how rich people will get benefited by this, right? So in this case, what we should do? Widening inequalities is a very long term trend which depends on deep structural change in any economy, such as globalization, technological process, demographic dividend. So when we talk about widening inequality, there are many things dependent on it. For example, if we talk about US also, in US also we have seen over last 2 decades that the income of profit earners has increased to a great extent, whereas the income of wage earners has not increased in that proportion, right? So inequality is a challenge there also. A properly managed monetary policy promotes greater economic stability and prosperity of economy as a whole by mitigating the effects of recession on the labor market and keeping inflation low and stable. So inflation will also be low, and the labor market or the effects of this kind of economic activities will be better in labor market. There is the need to rely on fiscal policy. Now there are two policies that we can understand here. One, the policy that we have already discussed, that is known as what? Monetary policy. So as we have discussed, monetary policy is under RBI. It is under RBI, right? It is under RBI. But when we talk about fiscal policy, this policy is under government of policy, government of right, government of India. That is the executive branch, basically executive, right? Government of India. Now fiscal policy is about two things basically. One is government expenditure, and other is about taxes, right? About taxes. So on this we classify fiscal policy under two categories. One is contractionary again, and contractionary fiscal policy, and expansionary fiscal policy, right? Now here you have to keep one thing in mind, that when we talk about expansionary fiscal policy, in expansionary fiscal policy, more disposable income will be there in the hands of people. So in expansionary fiscal policy, what happens? Government expenditure increases. Government increase their expenditure, for example, on healthcare, on education, etc. So when government is increasing expenditure, what will happen? More money will be there in the hands of people. So people will be having more money in their hands, more disposable income will be there, and people will be increasing their demand in the economy. So government expenditure increases, and or means either both thing can also happen, or one thing can also happen, that either government increases their expenditure or tax rate decreases. When tax rate is decreasing, then also people will be having more money in their hand, more disposable income will be there in the hands of people. This is one thing that understand. Similarly, when we talk about contractionary fiscal policy, that means people will have less money in their hand. When we are saying less money in their hands, that means government has decreased their expenditure, right? Government is not spending on healthcare, education. So what will happen? People will have to spend out of pocket on healthcare, education, etc. So government has decreased their expenditure, and the government has increased the tax rate. When taxes have increased, at that point also people will have less money, less disposable income in their hands, right? This is one thing that we can understand. So that is why fiscal policy and policies aimed at improving worker address distributional concerns, right? High skill will give lot of opportunities to the people, right? They will be having more opportunity. RBI monetary policy updates. Now, the Monetary Policy Committee of RBI meets 4 times a year. The committee recently held its meeting on February 8, 2023. This is the first time since Finance Minister Nirmala Sitharaman presented her budget. The committee has 4 members. During the meeting, the member decided on various aspects such as repo rate, interest rate, reverse repo, liquid adjustment facility, marginal standing facility, bank rate, cash reserve ratio, statutory liquidity ratio. These are known as what? These are known as quantitative tools of monetary policy. Quantitative tools of monetary policy. Right? Interest rate, reverse repo rate, liquidity adjustment facility, MSF rate, all. Key decisions were taken during the meet. So repo rate increased by 25 basis point, that is to 6.5%, earlier 6.25%, held in December 2022. RBI increased the repo rate by 35 basis points. Since May 22, RBI has increased repo rate by 250 basis points. Is being done to control the increasing inflation in the country. So if inflation is high, repo rate will be high, repo rate will be increased. Bond market timings were restored to 9 a.m. to 5 p.m. This permits to lend and borrow government security, and now it is available to retail investors also. MSF rate increased by marginal standing facility when bank park their this excess liquidity, right? That is marginal standing facility, standing deposit facility. These are the data related to this. Now, what were the policy rates? So earlier policy rate SDF was 6%. Now it has been increased to 6.25%. MSF was 6.5, now increased to 6.75%. SLR 18%. That is sorry, SLR is related to how much, for example, this bank, this is bank, and bank is getting receiving deposits, right? So for example, banks have received 100 rupees as deposit. Now this entire 100 rupees cannot be lent as a loan to the borrowers by the bank. Why? Because maybe these depositors can demand their money back, right? So this entire 100 rupees cannot be lent as a loan. So what conditions are there? So there will be SLR and CRR. SLR and CRR. This is cash reserve ratio and statutory liquidity ratio. What is CRR? CRR is to be held in the form of cash with the RBI, right? The percentage of total deposits, right? For example, here it is 4.5%. So out of this 100 rupees, 4.5, that is 4.5 rupee will be held in the form of cash with the RBI, right? With the RBI, 4.5 rupees. That is CRR. SLR is the percentage of total deposit that banks have to invest in bonds, right? Government securities. Government securities. So they will be investing in government securities here. So this 18% and 4.5% reverse repo, bank rate, and repo rate earlier. What RBI has said, that after holding the monetary policy meeting, the RBI made the following announcement. What kind of announcements are there? Inflation in the country to stay above 4% GDP forecast. That is above 4%. Inflation is above 4%. Now we have already seen that inflation targeting is 2% to 6%. That is 4% plus minus 2%. In 2024, it is to reach 6.4% in the first quarter. The GDP is to touch 7.8%. And in quarter 2 it is to reach 6.2%. In quarter 3 GDP will reach 6%, and in quarter 4 it will be 5.8%. Now Vivad se Vishwas, this is the scheme of the central government. Vivad se Vishwas, right? From conflict to confidence. That is, during COVID, the government of India had collected a fortified amount. This forfeited amount means the loss of something, right? So this forfeited amount, when someone fails to pay the money he owes, forfeiture occurs, right? So forfeiture has occurred when someone has failed to pay money. Government of India collected forfeited amount, something like a fine, from companies that failed to oblige their contract, and also for other reasons. Finance Minister Nirmala Sitharaman recently, while presenting the budget, announced that these amounts are to be returned as they hit the MSME sector, because MSME sectors are struggling a lot after COVID. So government is announcing a lot of schemes. For example, interest subvention scheme is also one among them. So when government is announcing these schemes, government is also returning the kind of fine that they have collected from MSME, right? MSME sector runs on small investment. For example, the revised definition is also there, depending upon their investment and turnover. The rotation of money is in the hands of MSME is also less. So less money is small enterprises. They are the MSME, when we say it is micro, small, medium enterprises. Micro, small, and medium enterprise, right? So they are running on very low investments, right? Low investments, low turnover. So during COVID, what happened? MSME sector faced several challenges because lockdown was there, right? And they were not able to do business. Their day-to-day activities, transport, raw materials, and other activities were all affected due to the COVID lockdown. For this reason, they could not stand by their contract. The government had collected forfeits of their failed actions. This happened because of the government could not take immediate steps and address the issue quickly. With COVID pressure easing on the government of India is returning the forfeited money that they have collected. Vivad se Vishwas. All these actions are to be done under Vivad se Vishwas scheme, right? Conflict to confidence. The significance of this is 95% of forfeits were related to bids placed by MSME, the kind of auction that they have participated. So when they have placed bids, now they have to comply. Since they were not able to comply, some forfeitures were there. MSME has a huge role in economic growth of the country. They contribute 36% of total manufacturing sector in India. The role of micro, small, and medium enterprise, right? So this is related to MSME or Vivad se Vishwas scheme. Now, Securities Exchange Board of India. When we say SEBI, it is Securities and Exchange Board of India, has released new guidelines. So new guidelines for portfolio managers. Portfolio managers related to mutual funds when they are creating a portfolio, has released new guidelines titled Performance Benchmarking and Reporting of Performance by Portfolio Managers. The guidelines, which will come to effect from 1st April next year, provide certain performance reporting and benchmarking norms to improve transparency in the disclosure of portfolio managing firms or portfolio managers. Right? What are the key features of new guidelines? The Association of Portfolio Managers of India, that is APMI, is mandated to prescribe a maximum 3 benchmark for each strategy, that is equity, debt, and hybrid and multi-asset. Right? For example, when we talk about these mutual funds, or for that matter these portfolios, when you are creating portfolios, what we do basically, this is the kind of bucket that we create. In this bucket we keep shares of, for example, pharmaceuticals industry. So pharma industry will also be there, automobile industry will also be there, right? Automobile, pharma sector, or for that matter various other, for example, services sector will also be there, right? IT, infra, etc. So various other sectors combined together form a unit, this formation is known as what? Portfolio. This design is known as what? Portfolio, right? So managers, firms, enterprises, etc. are involved in this. The portfolio manager is required to choose a benchmark that best reflects the core philosophy of the strategy. The feature ensures transparency of clients and help them assess the true performance of the strategy. The guidelines allow the portfolio managers to change the benchmark whenever required. However, they can do this only after offering an option to subscriber to exit without any exit load. Exit load means when you have to pay something when you are exiting, right? The performance track record of the strategy that was used before the change will be used by portfolio managers when reporting to the performance in the future, right? Reporting the performance, that means the portfolio manager services firms managers are mandated to disclose the time weighted rate of return, right? Time weighted rate of return means what will be the kind of return, how much risk is involved, how much return can be there, and trailing return disclosure of the selected benchmark. TWRR does not include the impact of intermittent cash flow from subscription and redemption on the returns of each, right? So this is related to this portfolio managers, PMS managers. PMS managers, that is portfolio management services firms. PMS managers are also required to disclose extended internal rate of return, extended internal rate of return, that is XIRR, for each strategy the investor invest in. So wherever you are investing, the XIRR has to be disclosed accordingly. Since PMS caters to individual investor requirements, portfolio of one investor will be different from another one, right? And the guidelines mandate to the PMS to explicitly communicate this to the subscriber. Also required to disclose their marketing materials, the relative performance against the benchmark, and also other portfolio managers within the specific strategy. They must not disclose model portfolio returns and the performance of one or more cherry-picked investor in any communication with the client. However, aggregated performance statistics has to be included. So when they are showing their performance, it is not like they are choosing one customer and showing their performance, that how their portfolio have performed. No, this is not like this should not be the case. Rather, the aggregated one will be shown as their performance. Currently, the PMS managers are submitting monthly performance report only to SEBI. The guidelines require the manager to submit these reports to APMI as well as SEBI within 7 working days from the end of each month, right? The APMI will then make these reports available on its website, so that user friendly manner, so that people can have access to it, right? Valuations, the PMS managers are required to follow APMI prescribed norms for the valuation of the portfolio of debt and money market. The rules will be the same as the corresponding norms that are applicable to mutual funds. Now, the APMI is required to impanel the valuation agencies to provide security level price of portfolio managers. The portfolio manager must mandatorily use valuation services provided only by one or more such impaneled valuation agencies, right? Related to SEBI new guidelines. Also, SEBI bars AIFs from raising capital from a non-compliant foreign investor. Now let's see what exactly this particular update, right? This particular current affair update. As per SEBI, a foreign investor must be resident of country whose market regulator is a signatory of either International Organization of Securities Communication Commission, that is IOSCO, or has a memorandum of understanding with SEBI. Suppose a foreign investor is there in any country and he himself is not registered in India to invest, right? So he can uh, put money, if he can put his investment in SEBI or in stock market of India, whether they have some their regulator is a signatory of either International Organization of Security Commission or having memorandum of understanding with SEBI, right? This is an international body for securities regulators and standards. SEBI is a member of it, right? Now, RBI of India puts on hold NUE licensing, new umbrella entity, right? NUE licensing. What exactly it is? So RBI is said to have put on hold licensing of the new umbrella entity network of fintech institution, financial technology, or technical institutions in financial market or in financial sector. A rival of the National Payment Corporation of India, NPCI, 6 groupings which include Facebook, Google, Amazon, Flipkart, and others had applied for NUE licensing, new umbrella entity, right? But none of them could meet the RBI's expectation in bringing technology breakthrough. What is retail digital payment system? Retail payment, not in bulk, that is the retail customers are doing. The retail payment system facilitates the transfer of funds from consumer to merchants in exchange of goods and services. NUE is an entity under the Companies Act 2013 that will manage and operate the new payment system in the retail sector, such as ATM, POS, UPI, etc. It will also manage clearing and settlement system that could be an alternative to the bank promoted NPCI, National Payment Corporation of India. It will be allowed to charge fee for transaction, unlike the existing NPCI. Now, RBI had in 2020 issued guidelines for corporates to create non-profit NUE with an aim to foster competition and de-risk India's burgeoning digital payment ecosystem, where much of the settlements burden fallen on the non-profit NPCI over recent years because of digital um, payment boom. Also, we can say this. NPSCI was established by the RBI and the Indian Banks Association in 2008, modeled on non-profit payment and settlement entity run by the Swedish Central Bank that's owned and operated by the bank. It has developed the country's key payment railroads, including UPI, the immediate payment system, that is IMPS, RuPay, and National Financial Switch. It's also credited with the powering of direct benefit transfer, that is DBT architecture, that supports the government Jan Dhan Yojana. Aadhaar enabled payment system is also part of it, that we have seen in one of the discussion. Report on trends and progress of banking in India in 21-22. In a recent report, Trend and Progress of Banking in India 21-22, RBI said that banks must ensure due diligence and robust credit appraisal to limit credit risk, because when banks are lending loan, they are also having a lot of risk. For example, if the money will not return to bank, what will happen? That may turn into non-performing asset also, that is known as NPA. This report is statutory compliance in accordance with the Banking Regulation Act 1949 and presents the performance of banking sector, including cooperative bank and non-banking financial companies, that is NBFCs, that we have already seen. Key findings of the report: double-digit growth in the balance sheet of scheduled commercial bank. So growth is there. This is a good news for the banking sector in India. Scheduled commercial banks are those banks which are included in second schedule of the RBI Act 1934 and which carry out the normal business of banking, such as accepting deposits, giving out loans, and other banking services, right? Gross non-performing asset. Non-performing asset, the loan that banks have extended and it has been more than 90 days that the banks are not receiving, neither receiving the principal amount nor the interest amount, then it is known as NPA, non-performing asset. There are different terms that is being used for it. For example, special mention asset 0, special mention asset 1, special mention asset 2. For this is for not up to 30 days if you have not received it, up to 60 days, up to 90 days if you have not received it, and after 90 days it is known as non-performing asset. The banks have extended loan, but neither they have received this principal amount nor the interest rate. This is related to, right? I hope you can understand it. Reason for decline in GNPAs: banks have given write off the upgradation, greater scrutiny and monitoring of loans, greater recovery of loans after IBC, insolvency and bankruptcy code, right? For example, when the firm is not able to repay the loan that they have taken, so they can go for liquidation also, right? Liquidation is one option that is there. Otherwise it can be purchased or it can be bought by different firms as well. That is the provision under insolvency and bankruptcy code. The financial performance of urban cooperative banks showed improvement. Non-banking financial company NBFC sector improved in 21-22 with strong capital buffers, adequate provision and sufficient liquidity. NBFCs are poised for expansion, right? NBFCs or non-banking financial institution, we have seen that the institution have been registered under Companies Act 1956. NBFCs offer bank related services only without having banking license. Even though NBFCs provide financial services, they differ from banks in many ways, right? So these are related to the recent updates, recent report that has come in, right? So thank you all for watching this video, having these information at the platform of Victory IAS. So we will meet in the next class to discuss more updates on economy with respect to current affairs. Thank you very much. Take care. Bye bye.